Ukraine and the Middle East, while tensions run high between the U.S. and China. All at a time when Americans are months away from a consequential presidential election. For the U.S. economy, resilient economic data and hawkish Fed talk is pushing back hopes for multiple interest rate cuts.
We want to gain further confidence.
Whatever the world is pricing in for a soft landing, I think the chance of something going wrong is higher than people think.
At the same time, equities are trading at record levels, and the private credit industry has ballooned to a $1.7 trillion opportunity.
NVIDIA is now the world's most valuable company.
But questions remain about how much further this bull market can run. Are there cracks in private credit starting to form?
There's going to be some likely credit events down the road.
And which market events could throw the global economy into disarray?
Financial markets, generally speaking, work very well until they catastrophically come off the rails.
When it comes to your world, your money, and your burning questions, prepare for answers from the leaders that know how to build empires, protect portfolios, and create the next big thing. This is Bloomberg Invest.
Please welcome to the stage Bloomberg's Shonali Basak.
Everybody, welcome to Bloomberg Invest. We have worked very hard for you for the last year to bring together top names in asset management, wealth, deals, investing, and certainly they will be sure to deliver. And we've had some great conversations already started this morning, including Man Group's Robin Grew. A lot of conversations around AI will certainly pervade today's discussion and tomorrow's as well. We're here for the next 2 days in the heart of the financial district to deliver the most consequential conversations on risks and opportunities across asset classes, economies, and markets. And to set the stage here, we have a stock market that was very recently at record highs. Interest rates have begun to moderate, but the future is still uncertain. Risks abound. Geopolitical tensions are simmering. There's a U.S. presidential debate just days away, and many investors believe there could be volatility from now until November, if not months after. We have some of the biggest names in finance to deliver perspective on all of this, and that includes hedge fund heavyweights, including Coatue's Philippe Laffont this morning, Cliff Asness and Boaz Weinstein, global credit investors like TCW's Katie Koch and Apollo's John Zito, and deal makers including Paul Taubman and Ray McGuire, who of course have worked on some of the largest deals in the world, and private capital titans like Josh Harris of 26 North and Michael Arrighetti at Ares. And before we get started, a couple of announcements. First, we would like to acknowledge our presenting sponsors: Android, Invesco QQQ, Mass Mutual, and our supporting sponsor, Principal Asset Management, and our participating sponsor, Southern Company. If you want to connect to Wi-Fi, very important, you have information on your badges and on screens as well. We'll be flashing this QR code through the day for you to participate in polls. This is not one of those conferences that we don't want you to have your phone. We very much want you to participate with us and to submit questions and have for our speakers. Please bring them to us. We're going to do our best to get them answered for you on stage. If you grab your phones now and scan this code, you'll toggle back and forth between the Q&A and polling at the bottom of your screen. And we're going to get you warmed up with our first poll. And the question is the question of the year. How many interest rate cuts do you expect from the Fed in 2024? 1, 2 or more, none at all, or you're worried about another hike? While you do that, a few more announcements. You can also follow today's coverage and engage in the conversation on every major social media platform using the hashtag BloombergInvest. The handle is at Bloomberg Live on X, also known as Twitter, LinkedIn, and Instagram. And if you have a Bloomberg terminal, of course, you can look for today's conversations and look back at them if you've missed them at Live Go. We also have an event app. The QR code to download this, and you can use this code, is the Bizzabo app. You can access the virtual networking community, chat with more people that are in the audience today, build your agenda for the day. There's a lot going on. and turn on push notifications to get reminders throughout the event. And where you have voted, see if we can get these poll numbers up now. Of course, it'll guide a few of the things that we're looking at throughout the day here. 1, overwhelming majority. We will see if everyone else thinks so throughout the course of the day today. Of course, we have a lot of credit managers where that matters a lot too. Now, without any further waiting, we're going to get this program started. He built Eldridge Industries into a multi-billion-dollar empire with investments ranging from financial firms to media franchises, and of course, he's invested in a few sports franchises himself. Bloomberg has reported recently that he's looking to his next adventure with a new asset management business. Please welcome to the stage Eldridge Industries co-founder, chairman, and CEO, Todd Boehly. Okay, one more interactive. Show of hands. Who in the audience is a New York sports fan? LA sports fans. Todd, you're a little outnumbered here. We will come back to sports. We will want to know the future of where you're going to put your money there. But before that, you were, many people forget this sometimes now that you're at Eldridge, you were behind the strategy and a lot of the deals that made Guggenheim into a more than $200 billion asset management giant. And then you formed Eldridge. You pushed it into media, entertainment, finance, sports, real estate. In your mind, what are the themes for the next 10 years that will form the future of asset management?
Well, if I knew that, I wouldn't share it. Well, thank you very much for having me, first off. I think, obviously one of the things that is driving is scale. Value in scale, value in brands. And I think that's not limited to asset management. I think that's more broadly defined. But I think scale is continuing to become more and more important. And obviously, as you scale, then the question is there's a tension between scale and rates of return, right? Because, of course, as you get bigger, it gets a lot harder to generate rates of return. So I think you have to find places that you can go where you have the opportunity to make rates of return that are better than average, and at the same time get the benefit of scale. Whether it's compliance or marketing or anything that you're doing, there's a lot of value in scale. And you see now, in 2007, if you go back and look, right, the 5 largest alternative asset managers were all roughly the same size. It was Carlyle, it was TPG, it was Apollo, it was KKR, it was Blackstone. And they were all roughly $40 billion of assets under management. And now you look what they've done. They've all grown significantly. Blackstone's worth $150 billion, KKR's worth $100, Apollo's $70. So these things have really grown through the benefit of scale. And I think there's been a couple things that, the ones that have really grown have done really well. I think they've accessed retail money. So they have partnerships with, the big wirehouses, and everyone now is on a hunt to get to the independent RIAs. Because if you think about where the pools of capital, where alternatives aren't, the RIA is a giant market. So, I think as we're thinking about what we're doing, one of the things that we have is a really scarce asset in the form of an insurance company that issues retail policies. And we believe we're just entering kind of age peak 65. Over the next 4 years, there'll be more people that turn 65 in America than any time in the history of our country. So what do people want when they start thinking about, the future when they're 65? In our opinion, they want income. And income strategies are really what we want to be set up in order to deliver.
Is this one of the reasons you think that insurance has become such an important part of the private asset industry, the retailization of the industry?
Absolutely. But I think then you also have to look at the size and scale of the industry. Right? I've just quoted the size of the top 3 largest asset managers. 25 years ago, roughly, Berkshire Hathaway was worth $40 billion, $45 billion. Now it's worth close to 900. So when you think about the size and scope of the opportunities, the insurance industry is just massive. And so, I think that the opportunity to continue to grow insurance. And I think insurance globally is becoming more and more in vogue, right? Saudi Arabia just transitioned their regulators so that the insurance industry has its own regulator, because there's really no insurance industry in Saudi right now. So what they want to do is decouple it from inside of the general financial services regulations and build their own dedicated regulator so they can then build the asset class, right? Because, of course, if you look at the big project that Saudi's trying to do, these are long-dated infrastructure projects which line up beautifully with long-dated insurance liabilities.
So we reported recently that you're creating a new money management firm that has really big ambitions, and this was according to Bloomberg sources. You actually didn't comment for the story at the time. Is there anything you can tell us about the ambition here?
Well, as I mentioned, having an insurance company, we're pretty the only top 10 fixed annuity underwriter that is quote-unquote independent. So when you go looking through the list of who's the top players in those forms of insurance, they're all either attached to an alternative asset manager already, or they're all mutuals. And mutuals really are not going to be subject to M&A. So we're really the only one that's independent that is in the top 10 of both FIA and fixed annuity. And these are really easy liabilities to understand. So I think that our opportunity to continue to build our business around that, with the idea that we're going to be the largest investor in every fund we launch. So we're going to be alongside as we grow and scale, and we want to do it in just credit, right? All things credit. We've got a great track record in real estate credit, structured credit, private credit, great history in equipment finance. So all of these areas, we've got good track records and a lot of experience. And I think that they're just going to continue to grow, as the market continues to grow, right? There's a lot of discussion around private credit. Broadly syndicated loans are private credit, right? So, the definition of private credit, I think, is an interesting thing. But I don't think that the boom in private credit all of a sudden suggests that private credit is bad asset class, right? We're seeing a general debanking going on, and the credit sources are transitioning into, frankly, less levered holders, right? So if you look at the BDCs, right, the BDCs are a lot less levered than banks. So I think it's a lot safer for systems that are moving credit into lower levered institutions than traditionally where they were formed. But we think there's a big opportunity in credit. And what we want to do is just be all things credit, in partnership with our insurance company.
I want to talk more about credit for a moment, but really recently in the market, it was very widely reported that you were looking at buying a fairly sizable private credit firm out of Europe. That firm, we've reported, has gone off to seek potentially a management buyout instead. What does this say about your ambition to consolidate the asset management industry? Are you looking at more private credit firms? How large would you make of an acquisition?
Well, I think if you look out there again, there's a lot of these businesses that are somewhere, let's call it between 30 and 50 billion of AUM. And they're trying to figure out what's their growth strategy. And I think in partnership with an insurance company that's growing, scaling, and is reinvesting its capital into that growth, there's a lot of opportunity, because the insurance company, as it grows, the asset manager grows, right? So you get the benefit of the scale of the insurance company generating more spread-related earnings, and then you get the benefit of the asset management growing and generating more fee-related earnings. So it's this great combination where through kind of $1 of equity capital, you get two benefits.
So this will anchor, I think, a lot of our discussions throughout the day here. It's a really interesting environment for credit. Interest rates, even if you believe that you'll get one rate cut this year, they're higher than they've been in the last decade. What kinds of opportunities is it creating for you in the credit market more broadly?
So I think there's a couple places that are very interesting right now. I think real estate credit is a good place to be, because I think you see regional banks are pulling back, and I think the value of real estate has it stalled out a little bit. So you're going to have to be in a position where you need to refinance these loans, and with SOFR where it is, you're making kind of 9, 10, 11, 12%, on an unlevered basis. So I think those are really good rates of return. We see opportunistic examples, like, for example, we bought $1 billion of loans out of PacWest Bank. When the regional bank tremor occurred, the banks were trying to figure out how do we fortify ourselves, and therefore they're selling assets. And generally the way that works is they sell their best stuff first. So we were able to buy $1 billion of loans out of PacWest, and already roughly 20% of those loans have already refied themselves out. So it was a good opportunity to be well placed and to be able to move quickly. I think another place that we're excited about is this world where there's a bunch of these kind of growing disruptive tech firms that maybe raised money in 2021 or 2022, and they're going to need some growth capital. There's clearly value in the firms based on the fact that other businesses would love to buy them, because I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses. So real estate credit, kind of structured credit, and growing disruptive tech firms, and then opportunistic credit, because there's definitely going to be some things that go wrong. So to be in a position to be able to move quickly, we're working on one right now where we're buying senior secured debt at 50 cents on the dollar and taking control of a position.
What goes wrong? If you think about the next 6 to 12 months, there's a lot of concern that these prolonged interest rates will start to create serious cracks in the market. Where are you starting to see them?
Well, there are definitely places where, there's been, I think, if you look at the liability management exercises that are going on, there's been something like 30 or 35 of them. And 14 or so have been kind of what we'll call repeat offenders, where the borrowers have already done a liability management exercise, so they didn't end up kind of solving their problem. They just kind of kicked the can down the road. So I think it's specific to industry, right? If you go back and you look at defaults ripple through industry, right? So generally there's something going on in an industry. So defaults generally spike, in an industry. I think everyone obviously talks about the real estate stuff. I've never found that anyone has been able to predict the thing that's been the problem, right? Generally, the thing that is the problem is a surprise. So, I think we're going to see this sort itself out would be what I would bet. But obviously, I think we're also living in a world where, a 4.25 10-year people think is high. If you go back and look at time, a 10-year at 4.25 is not high, right? So I think we'll see over time the front end of the curve come down, and the back end of the curve will kind of stay where it is. But I just don't see that the higher for longer is necessarily going to be the thing that crushes us.
So moving from credit to equity for a moment here, because you do at Eldridge Industries have a very interesting portfolio that is very diverse across the industries you play in. And if you think about kind of the topic du jour, artificial intelligence, very, very curious on how artificial intelligence is impacting your portfolio companies. Where are you seeing the most promise?
Yeah, so the first thing I would say is that when management and ownership are significantly overlapped, right, the ability to be on the front foot is very different than when management and ownership are completely disconnected. So just take the media industry, for example. A24 is a company that we founded in 2012. 2 years ago, they were the first studio to ever clean sweep all big six of the Academy Awards. Best Picture, Best Actor, Best Director, Best Actress, Best Supporting Actor, Best Supporting Actress. So they clean sweep all six. They're significantly owned by their founders. So they're in a position to figure out how are we going to use AI in order to make our content faster, better, quicker, cheaper. And at the same time, they have the credibility to bring the actors and actresses with them on the journey. So, because let's face it, it's coming, right? So, you have to be able to figure out how do we win collectively, in this journey. You look at what's going on in, kind of large publicly traded media companies, and I think they're on the back foot playing defense because management and ownership really don't wear the same hat, right? They have a very disconnected view of the world.
Is what you're saying that this makes a difference in terms of how they invest in technology, in AI?
I think it makes a difference on whether they're on the front foot or the back foot and how they, kind of come to grips with, we have to embrace this, and figure out how to tackle it and figure out how to do it so we're all going to be on the same page going forward. But the reality is it's coming, right? So I think if you look at, insurance and how we're thinking about how it's going to affect insurance, processing of insurance, call centers, right? We're now using AI in all of our call centers to service our insurance policies, and it's just a better experience, right? We used to have to monitor, calls to figure out how the call center operators were doing. How many calls can you actually monitor, right? 50 basis points of all the calls? Now we basically get full transcripts of every call. When you hear tension rising, when you hear certain words, it automatically kicks that transcript to a manager who can then decide. And of course, what also was happening is every call center employee would have to give a summary of the call. So they'd have to take the call, write down the call, the description of the call, and as you can imagine, no call ever went wrong.
So I want to switch gears here and promised you sports. We'll get to sports because you were really a pioneer here. You're seeing more and more private equity executives, either on their own or through their funds, enter the sports world. From everything you've learned, let's talk about some of the teams that you have. What's the future of the Dodgers after owning it for this long?
I think we're scratching the surface on what the Dodgers can be. I think if I had to bet, the Dodgers will be the first team to hit $1 billion of revenue. I mean, I think we've got a global franchise. We've got some superstars that have amazing appeal. We've got a team that is competitive year in and year out. Right? Every year we look at it and we roughly believe that we have somewhere between 18 and 22% chance to win the World Series. Right? So everything we can do, we're trying to figure out how do we improve the odds of winning the World Series. And, I think, unfortunately, if it weren't for injuries, you would be able to have a much more easy way to predict that. Injuries are just part of the game now, right? And you have to be able to handle how you think about depth, how you think about the quality of the players, and what they can do. Obviously, one of the things that Andrew Friedman, who runs the Dodgers for us on the sports side, he really focuses on how do we find players that have the ability to play multiple different roles. Right? We want utility guys who can play infield and outfield. We want guys who can hit lefties and can hit righties. And you're trying to figure out how do you build a portfolio of 25 players. And of course, one of the things that we love about Ohtani, is he gives us a 26th player, right? When he's pitching and he's hitting, we actually have a 26-man roster. So, which is such a unique thing, right? I mean, no one's been able to do that since Babe Ruth. I think our global appeal with our global superstars is really going to be driving the demand. I mean, we were in Korea this year. We opened up this year in Korea. And the amount of people who were hanging around trying to just see Ohtani, it's unlike anything I've ever seen.
What about Chelsea? Speaking of going global, when you got into the Chelsea Football Club, obviously that was a very big moment for an American private equity titan to be getting into European sports leagues, certainly European football, yet now Chelsea is being watched across America as well. What's the strategy?
There's very few brands that have the reach that Chelsea has. And Chelsea is you can see it and you feel it differently because it means so much to so many people. And, as I tell everyone, the good news is the bad news. It means so much to so many people. So when things are going well, everything is great. And when things aren't going as well, things aren't as great. But obviously our commitment is to win, right? We're here to win. And I think, our perspective is, how do we build something that has real staying power like we've done with the Dodgers? And putting together, that team that, is very fluid and comes together, I think that's the first step. And, I think putting together any team, whenever I put together any team, right, it just takes time. That's the only way to phrase it. And, I think we feel very good about the pieces that we have together, the camaraderie that the players have, and what the future looks like.
Where is your next big bet in sports?
So I think there's a lot of things going on globally, right? And what's the world has done as distribution costs have gone to zero. I mean, if you go back and you talk to Fox or Rupert Murdoch, and you think about what he did to build Fox, right? At that time, before you could buy the content, right? Before you could buy the intellectual property to broadcast on Fox, the infrastructure that he had to pay for was so massive, right? So just putting together the nodes that would allow for the broadcasting was hundreds and hundreds of millions of dollars. As technology has evolved, those costs have come down, which is why the IP costs have gone up, right? Because, of course, as the hardware costs go down, the soft costs continue to go up because the soft costs you can't replace. The intellectual property is irreplaceable. Obviously, the technology costs going down, there's lots of ways to drive technology costs down and distribution costs down, but there's only one place to go for the intellectual property. So I think that we're going to start to see ongoing global expansion of these brands. I mean, basketball in Europe, what's going to happen to basketball in Europe? Europe has been an amazing place. If you look at the draft this year and you look at where players are likely to be coming from, there's more international players expected to go in the top 20 than there are U.S. players. So, I think these games are growing in demand. So how do you figure out how you position yourself to be, in these markets where there's demand, there's opportunity, and you want to be positioned to capitalize on it.
CVC, others, Redbird, they've considered putting billions of dollars into college sports. Would you consider putting similar dollars in?
I think college sports is on the precipice of major change. I think if you look at what college sports should be thinking about, right, there's a couple things right now that they're struggling with. One, NIL is the wild, wild west, right? So there's no standard, right? But in order to standardize NIL, there's going to have to be collective bargaining. So how do you figure out how to do collective bargaining in a system where it's very fragmented? Secondly, you have this transfer portal where, that again is the wild, wild west. So there's going to have to be some form of regulation, especially now that there's compensation, because this is going to change everything. I think we're in the early days and people really don't understand. But, I think one of the things that I'm part of a group and we're thinking a lot about, right, is how do you build a proper, league with maybe 10, maybe 12 divisions, maybe 6, maybe 8 teams per division, right? There's roughly 130 Division I schools. So how do you give them all the opportunity to compete, right? But of course, there's major brands that are going to want to make sure that if they're chipping in, that they get what they deserve because they're the brands that everyone's watching. So, in a perfect world, you have 82 teams, 70 teams, 85 teams, something like that. You have a relegation and promotion element to it where the other teams can come up and compete. And you really start to think about how do you make it so it's truly national, right? And so I think there's a commitment, but there's obviously a lot of ingrained challenges in that because there's stakeholders that aren't interested in losing what they have today. So, but ultimately, I don't see how you're going to deal with NIL and you're going to deal with transfer portal and you're going to deal with collective bargaining without a proposition that's much more complete.
Todd, as always, a lot of answers, a lot of questions left open. Wish we had a whole hour with you. That is Todd Boehly. He is the founder of Eldridge Industries. Thank you so much for moving us ahead in this program and really setting the stage for today. Thank you.
Please welcome to the stage Philippe Laffont, founder and portfolio manager at Coatue Management, with David Rubenstein, co-founder and co-chairman of the Carlyle Group and host of Bloomberg Wealth.
So I guess we got a different memo on the dress code for this. Yes. Is that your normal wear when you're trading?
When I invest, not when I trade, but yes, I've sort of lost the suits. The truth is I don't fit in them anymore.
Okay.
That's the problem.
I know that problem. So let me, for those who may not know, Philippe is native to France, came over to the United States for college. We'll talk about that shortly. But he has built one of the largest hedge funds that focuses on technology-related investments, Coatue, and now managing roughly $50 billion. So tell me, is AI overhyped? Because everybody wants to talk about AI, and do you think this is going to be like a dot-com bust at some point, or is AI really here to stay and the values are not too out of whack?
Yeah. Thank you. You promised you would start with an easy question. And we go straight to the heart of the matter. Listen, short run, it's true that the mentions of AI in every TV and written form is very high. And so one could say, wow, if everybody talks about it, it must be priced in. And the only reason why I'm more positive is I remember when I invested in Apple in 2009 when the iPhone first came out. And for years, people told me, why are you invested in Apple? Everybody talks about Apple. And obviously, it had an incredible run. So I actually think that sometimes because someone speaks a lot about something, it might be actually a good sign versus an overhyped sign.
Now, some people on Wall Street say the best way to invest in AI is go invest in the big companies that are already doing AI, Google, Facebook, Microsoft, and so forth. Others say go find the smaller companies that might grow into the next NVIDIA. So what is your own view?
I'm conflicted. On one hand, the history of technology seems to be that the big get bigger. But also, sometimes out of nowhere, a new company gets created, like Facebook or TikTok. And at the beginning of these new waves, the new winners, 10 or 20 years out, some of them are existing companies, and some of them are new. But the new ones that get big, there's maybe one a year, no more.
All right, let's suppose I say I missed the AI wave. I wasn't smart enough to get there. But there's another technology wave always coming along. So what's the next technology thing I should invest in if it's not AI? What's coming behind AI that's going to excite tech investors?
Two things. One is if you peel the onion of AI and you think about all the building blocks necessary for AI, you might stumble on real estate with data centers or utilities with power. I find the power is really interesting. So it shows that before I answer the new, there is a sort of an onion effect and you can peel it. There's a lot going on with AI. On the new thing, AI is sort of going to be this amazing sort of artificial brain. What I wonder is what happens when you put that brain inside of a robot and we humans need to then live side by side with humanoids. I'm like, wow, I don't know exactly when it happens. Maybe it's 10, 15 years. Musk says it's 5. Other people say it's 25. Take the average, 15 years. That's going to be pretty exciting.
Okay, what about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big. 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
Now, hedge fund investors who invest around the globe, and you invest around the globe, but more in the U.S. probably than around the globe, but you always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason I love thinking about black swans, and at the office everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the U.S., I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
NVIDIA, which has now the highest market cap, is it dependent on production in Taiwan, so that if China were to invade Taiwan, would that really adversely affect NVIDIA?
I think it would adversely affect NVIDIA. It would adversely affect the stock markets around the world. It would adversely affect everybody in this room. If this happened, we think this could be obviously a very significant event.
Now let's talk about technology in this sense. France really invented the precursor to the internet. Yet France more or less...
That's what French people like me like to say. I'm not sure it's true, but yes.
All right, but maybe it's true, maybe not. But why is it that the major technologies that everybody here needs to get through the day are all based more or less in America? So Microsoft, Facebook, Apple, Google, Netflix, all these companies are American-based companies. What happened to Europe? Europe has 200 million more people than the United States. Why do we not have any technologies that Europeans developed that we need to use today to get through our life in the United States? What happened to Europe's inventiveness?
Listen, I think there's two reasons. And from my personal experience, I moved to the U.S. when I was 16 and I never came back. I recently also became an American citizen. One thing that I've noticed is some of the best European entrepreneurs, they leave to start their companies in the U.S. So there's some very famous companies like Snowflake, but they were started actually by 3 French people, but it's an American company. So I think problem number one is the U.S. is such an amazing country that a lot of people decide to start their companies in the U.S. Problem number two is if I'm in the U.S. and I start a company, I get money from people who are willing to lose it, understand the risk, and I can probably get a term sheet in a matter of weeks. Oh, if I try to raise money in Europe, good luck. And then after that, I'm in one country, and then I need to have a different set of regulation that I need to respect to be in the big 6. And then there's, 30 or 40 countries in the European Union, each with their own regulation. I'd rather start my country in the U.S., start my company in the U.S., then you move very quickly to Canada, UK, and Australia, and then from the UK, you move to continental Europe. That's what we see.
So everyone in the U.S. seems obsessed with whether the Fed is going to lower interest rates before the election, after the election. Do you have a view on whether the Fed is going to do either of those things?
I have a strong view, but I've never been right with respect to macro events in my life. So I will tell you what my strong view is, and it may be the opposite. My view is that the Fed is going to do what the data tells it should do, irrelevant of the election. Because if you do it before, you're going to favor one candidate, maybe. But then if you do it after, then in fact you're really favoring maybe another candidate, whether it's the incumbent or the insurgent, I suppose. And so I think that it's going to be whatever the data says. Now, I've always been wrong. I think I've predicted 7 of the last 3 recessions, something like that.
Investors also seem obsessed with who the next president of the United States is going to be. So are you worried that whoever is the president will make you have to make a different investment decision, or do you think whoever's president, it's not going to make that much difference for the kind of investing you do?
I think the next president for our kind of investment doesn't make much of a difference, because at the end of the day, we have such a strong country, very strong institutions, a system that is constantly looking to give money to the new companies, and I just don't see how that changes.
Okay. Let's talk about your background for a moment. So I can tell from your accent and what you've said, you're from France, unless it's a fake accent. That's a real accent, right?
When I was young, there was a time where the accent helped, but now I'm married with 6 kids, so the accent doesn't help anymore.
Okay, all right. So now, when you grew up in France, were your parents technology investors?
No, my father worked for an American company in France, and in 1981, the socialist government won, and they nationalized a bunch of country. And my father said, we're moving to the U.S., and that was just the simple reason. And I'm so thankful he took that decision.
So what age did you come here?
I was 16.
16, and you go to high school where?
I went to high school in New York at the French Lycée, so my accent obviously never got better. And then I went to college at MIT, and I was hopeful to be a great computer science major, and I turned out to be a very mediocre computer science major, hence why we're here in finance today.
So you had an obsession, as I remember it in those days, with Apple. You wanted to go work for Apple, and Apple did not hire you.
Correct.
So had Apple hired you, do you think you would be happier now or less happy?
God, I hate these questions. David always gets to the essence of the problem. I had 5 job interviews at Apple, and I was 0 for 5. So they clearly didn't like what I had to offer. I think that being an investor is better because you live vicariously and you meet all these interesting people. And I think at Apple, you work on a great problem, but hey, you get lucky, you work for the phone, you get unlucky, you work for the car, who knows? As an investor, God, we get to speak to so many people, and at the end of the day, why I invest so much, like to invest so much, is because you have a chance to meet the best minds and to learn.
All right, so how did you get into investing? You went to work for Julian Robertson at Tiger. How did you get a job there out of MIT? Did you do something before Julian Robertson?
So once Apple told me to take a hike, I actually did take a hike, and I went to live in Chile for 6 months, and I became a very good fisherman, and I still have that skill, and I learned how to speak Spanish, so I decided, well, I'm going to drown my sorrows, and I lived in Spain and worked for McKinsey in Spain, having that base in Spanish. And when I was at McKinsey, I saw all these famous CEO comes, and the McKinsey partners were so differential to them, and me, I was always getting the coffee for everyone. So I was like, okay, that was like note to self. And then it was very lucky because I was at McKinsey during the boom of the PC, and it was Dell, Microsoft, and Intel. And if you had invested in each of these stocks, you would have been a genius. Of course, it was pure luck. But I invested in those 3 stocks, and I made more money investing in the stocks than McKinsey. And then I was like, I'm done. I'm going to become an investor.
Right.
That's
how did you hear of Julian Robertson, or how did he hear of you?
So I interviewed for Julian, and I sent my resume, and I got a note from the IT department of Tiger saying, we don't need any more IT support staff. We noticed you have a background from MIT, but we don't need you. So I was like, damn, what can I do? And so I worked for free for a little mutual fund, but I learned just enough of the lingo that then after about 6 months, actually a French friend got me just to meet Julian for a few minutes. But that free job was the best thing I ever did because I learned just the basics, a P multiple, revenue, cost, profits, just enough to squeeze through the door, and that's how I ended up.
So you presumably did reasonably well there. And then when Julian Robertson closed his organization, he gave money to a number of his acolytes, and they called Tiger Cubs, I guess. And were you a Tiger Cub?
I'm still a proud Tiger Cub. Unfortunately, when I left, he wasn't still giving money to people. And so I had to go and raise my own money, and I asked my friends and family first for some money. And most of my friends and family either had no money or didn't trust that I was going to be a good steward of their capital. So I didn't raise any money from them. But America is a special place, and I met a lot of people, and some of them, they meet you for 15 minutes, and they're like, hey, I'm done, meeting's over, and then the next day you get a check from them to invest, and I started with $50 million.
Wow.
January 1st, 2000. That was brilliant timing in retrospect.
So the people that gave you initial money, were they professional investors or people that you happened to meet on social occasions? Who are these people? And
they were professional investors, and I had a prime broker who introduced me to these people. Some of them said no, but in this country, people like the underdog. People like someone who tries something new and entrepreneurial, and surprisingly, I was able to round up a few $1 million.
So did you ever tell the people that did not invest with you what a mistake they made?
I feel that vengeance is best served at times by not saying anything.
Okay.
So,
right. So you started with $50 million. What year was that?
That was basically January 1st, 2000.
January 1st, 2000, and now you're managing roughly $50 billion.
Yes.
So that's a pretty good increase.
We've added 3 zeros, but I think the fourth is going to be difficult.
Okay. So today, are you picking the stocks, and you do stocks and credit, and you also do private equity, but not control, but private positions, right?
Yes. We have a good team, and obviously different people for different products. They run the day-to-day, and what I try to work with them on is the big ideas and the risk, and let them sort of think about the individual names.
But your title is founder and portfolio manager. Portfolio manager is not a title that implies CEO or anything. Why do you give yourself the title portfolio manager?
You know, I gave that title to myself when I started, and then I never changed it because we're not super title-based firm. Maybe as we institutionalize, we should pay more attention. Maybe you can give me some suggestions after the interview.
I don't think you're doing okay without my suggestions. Now, your firm is named Coatue.
Yeah.
Where did you get that name? So
that name, as you know, is the beach opposite your house in Nantucket. And even before I came to the U.S., I would summer in Nantucket, and I started summering there from France in 1977. But imagine I was 10 years old, and I arrived to the U.S., and I go to one of these movie theaters with popcorns and whatever, Dr. Pepper and stuff. And the first 2 movies I saw were Star Wars and Jaws. And to this day, I'm like, this is why I love this country so much. When you see Star Wars as a 10-year-old in a foreign country, that's it.
So today, you're managing roughly $50 billion. And is your goal to keep growing this? And is it to keep doing what you're doing? The U.S. government might come to you and say, we need you to become in the U.S. government as Secretary of Treasury. You're now an American citizen. Or is this what you want to do for the next 10, 15 years of your life?
I can say with full certainty that I'm neither qualified nor hoping to work in the Treasury. Mostly, I would be completely unqualified. I'm impatient. I change my mind all the time. So those are a couple things that might be good for investing. And I love what I do. And I think with the capital base that we have, just if we could grow that capital base, we don't need that much new money. Now we have a big responsibility, and the thing that makes me happiest is I've had some investors that have been with me for 25 years. In some cases, they've made almost 20x return over the very long run, and obviously the future could be very different than the past. But I'm proud of what I've done for them. I feel investing is a bit of a craft, and I'm proud of that craft. It's risky, and you got to work really hard for it. And I just get this fire in my belly. I can't explain it why, but I wake up every morning and I feel this both fiduciary duty and this curiosity and meeting new investors. And it's just really exciting to try to see. You mentioned when we were out there that Buffett made 99.5% of his money after 50. I'm 56, so hopefully I stay healthy and I can do this for a while.
So you have 6 children?
6, yes.
And their ages are?
My oldest is 26 and my youngest is 11. But
and this is all with one wife, right?
All with one wife, yes.
So very unusual.
I have a friend, he has 7, but he has 3 wives. I'm like...
okay, so one wife and 11 and 26. Are any of them interested in investing, your older children?
My older child has not the slightest interest. I've got 2 or 3 that have investing, but I feel they have to maybe try to learn a little bit on their own and go somewhere else. And that investing and Wall Street, when the markets go against you and stuff, you have to be resilient. And I think you have to learn a bit of the resilience outside of the home business first.
So what's the biggest investment mistake you've made?
Oh, okay, I see we have 9 minutes left. We're going to need 39 minutes for that. But I would bucket the mistakes, right? A number of mistakes that I've made is too cute. Stan Druckenmiller once told me he made 120% of his money in obvious ideas and he lost 20% everywhere else. And I feel that's very true. But by far the biggest mistakes that I've made is selling stock early. And as an example, we made a big investment in Tencent in 2003. And having sold that position early cost our fund $20 billion as an example of the mistake. But I hear, David, that my mistake is small in comparison to your mistake in Amazon. If you would like to share it with if you would like to share that with the audience.
Well, it's too painful, but let's say I sold it all several years too early.
David had the chance to own 1 and 20% of Amazon, so I would call that more than a big mistake.
So, what is the deal you're most proud of doing, or the kind of things you're most proud of doing? Is finding some new company early on? What are you most proud of what you've done so far in your investing prowess?
I think it's twofold. One is provide longevity and good returns for your investors and have investors that bet for you for the long run and to really do well. And I know exactly, inception to date, how much money I've made from my investors and how much money I hope to make. And I think about that a lot. And then the second part now is I can't find all these young guys, despite how I dress. They know I'm 56. They don't want to hang out with me. Now it's finding great young people at the firm who have the chance to make an investment that in tech, what's so exciting is you're always thinking that you might find the next TikTok or the next Facebook. And it's finding these kids to help us do that.
Generally, when you're successful in the hedge fund world, you make a fair amount of money, as you have done, I presume. What do you do with your money? Are you a collector of art? Are you a collector of wine? I assume you're French and care about wine. Or are you a philanthropist? What do you do with your money, or are you just saving it all?
I can tell you that I'm obviously a collector of children.
Right.
That's my best investment outside of the office.
But unlike some hedge fund people, you're not a collector of wives, right?
No, I'm not. There's clearly something going on between the private equity world and the hedge fund world right now. Listen, I think someday, and I should probably do it sooner rather than later, you have a responsibility to take that capital and help others. So far, I've been a little bit, to be honest, it's been a lot for me just working and having the family life and stuff and not being too much in the limelight. And that's been my main focus. And I know I need to do something grander and bigger and more altruistic. And I haven't quite done it yet, but it's something I need to do.
You are a golfer or a tennis player. What do you do for exercise? How do you stay in shape?
I love the outdoors. I play a lot of sports. I played tennis in college, so I would say I'm a B+, A- tennis player. And then I love golf, and I never get better. And the more I play, the worse that I seem to play. So
is MIT famous for its tennis team? Were you the star of the MIT tennis team, or?
Not only is the team not famous, but I wasn't even the star. I was like a middle of the pack.
Okay, so as we talk about, we're getting ready for 4th of July soon. Why did you decide to become an American citizen? You're doing okay without being an American citizen. What propelled you to want to become an American citizen at this point in your life?
Yeah. Well, my kids are American and stuff. I just felt that this country had done a lot for us, and I don't mind paying my taxes here. I've only paid my taxes here. The U.S. is a worldwide income tax anyway, so it wasn't going to change. And I've spent 40 of my 56 years here. I didn't mention, but I do have a lot of wine. It's not necessarily the best wine, but I do enjoy an occasional glass of wine. So I've kept a few things from France, but I became American because at the end of the day, I love this country. I love what it stands for. I love that it's not just about working hard, and if you work hard, you have a chance. Everybody knows that about the U.S. To me, what I like about the U.S. is also what we stand and how we try to help the rest of the world. And some people don't like what we do, but I think by and large, thank God that there's a country like us. I even like the Tom Brady roast that so many people were offended by. And I just think the concept of a roast, and that when you become a really famous and incredible celebrity in the U.S., you still have to subject yourself to sort of rules and jokes, and that you're just a normal person. I really love everything about this country.
So when you walk down the street, people come up to you, they recognize you, or you're that famous now?
They don't recognize me, and I'm not sad about it, but our job is not a celebrity job. There's nothing fancy about it. But taking care of other people's money for some reason is something that I really enjoy doing.
Somebody's watching this. He's a young person who says, I want to be like Philippe. I want to be a professional investor in the hedge fund world. What is the best advice? Is it to get a good college degree, go to Spain for a while, go to Chile? What is your advice?
I think that my career involved a road that had a little bit too many left and rights along the way. And in fact, a couple times I had difficulties early on in my career. And I remember once I told someone, if you give me 5% of your business, I'll shut down mine and just come work for you. And he said, I'm really sorry, but I can only afford to give you 3. And I was like, 3 just doesn't sound enough. All right, let me give it one more year. Thank God the guy, he quit 1 year after that. So my advice is, obviously, when you go to a good school, the advantage is you meet interesting people. But there are a lot of good schools. They're not just 5 good schools. Number 2, as you learn the basics of finance, the mathematical basics of finance, keep an open mind, network, and have some fun hobbies. That's my advice.
So I assume MIT has heard of you, and they ever come to you and say, well, MIT needs a building named after you or something like that?
They did come, and unfortunately, we had a slight change of opinion on a subject that's not interested in. We are no longer in great terms with each other.
Okay, so you're interested in other universities you might be willing to give money to that I know of?
Well, there's one in Baltimore. I don't know if it's near you, but it's near your sports team. Listen, I think that some people, they love giving money to universities. For me, it just doesn't quite resonate. But yet again, I haven't found something else that resonates more.
So are your parents alive?
My mom is still alive. She's 86. If she's 87, she's going to kill me. I think she's 86 or 7.
She give you advice still, and does she tell you how proud she is of what you achieved?
She says this and stuff, and there was a time where they gave me more than just advice. They gave me advice, lessons, and orders. I think now I try to also help them a little bit. It's that time where it's for us to help them because they've helped us a lot before.
Because of the uncertainty in the economy, let's say right now where interest rates are going, who's the next president going to be, is it a good time to invest? Or would you say now is not a great time, wait till after the presidential election's over?
I always answer the same because divide your money in thirds, invest a third immediately, keep a third if the stock market goes down 10 or 15%, and use the last third if the market goes down 30%.
Okay. Well, look, you've built a really incredible company. Congratulations. And you're an example of immigrants coming to this country and really adding a lot to the country. So, and congratulations on becoming an American citizen. Thank you.
Thank you, David. I really appreciate it. Thank you.
Please welcome to the stage Bloomberg's Michelle Lynn.
Hi there, I'm Michelle Lynn, Global Head of Data Science and Insight for the Bloomberg Media Organization. Over the course of the summit, I've been given a wonderful opportunity to conduct a few polls that have been crafted by the participating sponsor of Bloomberg Invest, Southern Company. So before we hear from the next panel, I would love to conduct one of these polls right now. So whether you're in the room or virtual, it would be great. We'd love to hear from you. So if everyone could take out their phone and scan the QR code. To access the poll, you'll need to scan the QR code. And then a polling icon should come up on the right-hand side of the screen. Does everyone see that? Okay. So the question that Southern Company would like us to answer is, where is your company or portfolio on the path to net zero emissions? So your options are: net zero business model has been achieved, committed to reaching net zero by 2030, committed to reaching net zero by 2050, or not sure. So you could vote right now. Again, the question is, where is your company or portfolio on the path to net zero emissions? Everyone voting? All right, so we're seeing some answers now. So 68, 70% of us are not sure. About 15% are committed to reaching net zero by 2030. 14% committing to reaching net zero by 2050. And then 4% net zero model has been achieved. So thank you all for your participation, and thank you to Southern Company for this great question.
Please welcome to the stage Koch, the president and CEO of the TCW Group, and Robert O'Leary, co-CEO and portfolio manager at Oaktree Capital, with Bloomberg's Lisa Abramowitz.
Hello. Welcome. This, to me, is going to be the best panel, and I'm not biased at all. I've got two of the preeminent people in the credit industry at a time that we are potentially on the precipice of a real shift in the credit cycle. Joining us today are two people who have a lot in common. Both of them have TCW as some kind of root in their names. They both became CEOs in a very new market after having years of experience before that. Joining us, Koch, who is the CEO of TCW, Robert O'Leary, who is the co-CEO of Oaktree. And there's this question here about where we are in the cycle, Both of you grew up in this world, but then, Katie, you became CEO in 2023. Robert, Bob, you became co-CEO just in March of this year. Where are we currently in this credit cycle? Do you want to start?
Okay, great.
Go ahead.
Well, Lisa, first of all, thank you for having us here. It's great to be at this conference, and it's an honor to be up on the stage with Bob, who, as you mentioned, is the co-CEO of Oaktree. And as you also mentioned, the founders of Oaktree actually came out of TCW many decades ago, and this is an incredible firm, great investors, and tremendous leadership. So it's really an honor to be here with you today.
Same here.
So where are we in the credit cycle? Very quickly, I would say we think the credit cycle is quite mature, and we do expect there to be some challenges ahead, both in public and private markets, and we can come back to that. We don't think that necessarily the equilibrium rate is 5.5%, but it's also not zero, which means that by definition, things are going to get more restrictive ahead of us. And then you just have to think about the vulnerability of companies. Clearly, the ones in the IG space that have already termed out their debt are more secure. High yield has shorter maturities. They're going to have to refinance, obviously, eventually at higher rates. And then the most exposed would be those companies in floating rate structures, which we can talk more about. The second point I would make, and I alluded to it, but I just want to emphasize it, is that we do think markets are too complacent now. We don't think the very record tights that we have on credit spreads are reflective of some of the real challenges we have in the economic backdrop. Now, obviously, people are still bidding for credit largely over the last 12 months because you have all-in yield buyers, but ultimately the spread is what gives you protection, and there's not a lot of it now. So we would think there's more opportunity to skew to widen than to narrow, to state the obvious. And then the third point I just want to make is that there is going to be a lot of dispersion here for the reasons mentioned. And we think that's true, again, in both public and private markets. And it should be quite an extraordinary opportunity for active managers to be able to lean into the right places and be liquidity providers and take some pretty incredible returns for their clients.
All very well said and very consistent, I think, with our point of view. You know, if you look at what happened from the financial crisis probably until, 2022, there has been an unprecedented buildup in the amount of debt of all forms, but particularly the forms that, we specialize in. It's grown at a rate well in excess of the underlying economy. And when you've seen that kind of dynamic where debt grows in excess of economic activity, typically that leads to a blow-off or some sort of dislocation over time. That, we would have expected something like that would have already happened. Normally, you need some sort of catalyst. We've had a couple catalysts. We had the pandemic, obviously. We had the rate move. Now you're facing a pretty significant maturity wall. So we'll see how the market handles that over the next couple of years. But that maturity wall is only increasing. And, to the point you made, Katie, about dispersion, there are companies that are going to handle it just fine, and there's some companies that are going to fall out. And, over time, we think that'll be an increasing phenomenon.
So both of you seem to suggest that we're late cycle in this credit space, that maybe markets are overly complacent. One thing that's been hard to get your hands around is what does some sort of blow-off look like? A lot of people think about, it must look like a financial crisis akin to 2008. Otherwise, there isn't a near-term corollary in people's minds. Is it just an increase in defaults back to sort of historic norms? How do you sort of view what's ahead?
I'll start and then pass it over to you. The first thing I would say is that we lack the proverbial crystal ball, so we can't tell you if and exactly when there's going to be a recession. I mean, we know that that's the way the world moves, so we'll get that. But I'm interested if you agree, but our view would be that we can get some widening of spreads and some dispersion even in the absence of a recession because of restrictive rates. I don't know.
Yeah, very good point. I mean, you have, as you said, floating rate debt, companies that were predominantly floating rate debt experiencing a lot of stress, burning through, whatever liquidity buffers they may have had. And I guess the different feature of this particular cycle, which we're both well versed in, is the documents are so much worse than they have been historically. And that plays to the advantage of the sponsor. The sponsor is able to delay the day of reckoning. What would have been a default 5 years ago, 10 years ago, is now a liability management exercise, which turns into, an extended sort of a decline for these companies. We think it all ends in the same place, that there's defaults, but it may be more protracted this go round.
There's a lot to unpack there. This idea of, you're talking straight about private markets, and private markets have kind of grown up since the post-financial crisis era and really become something much more mainstream as an asset allocation that people commit funding to. There is this question of, has it gotten frothy within the private markets? We're talking about spread tightening in the public markets, but in the private markets, you're also seeing covenant weakening. You're seeing documents maybe get more forgiving and allow people to go on for longer before defaulting. Is that an area that you see a significant amount of the distress to come, or do you think it's just general?
Okay, so just going back to your original question, like I think we expect spread widening regardless of whether or not we get a recession. If we get a recession, obviously that will happen more. That's our expectation in liquid markets. And again, big opportunity for alpha there for people to lean in. So just to be clear, we do manage liquid assets as well. At TCW, we have a core plus type mandate. It's the core of people's retirement savings. That's the part of our firm where we would express a macro view. And based on what we've discussed here in that portfolio, we're very liquid, we're conservatively positioned, we're overweight agency MBS, carrying over the index, and we're waiting for one of these events that we just described here, some type of credit event where, again, we can step in, be a liquidity provider, and generate outsized return for clients. We just don't think you're getting compensated now for credit risk. So that answers your question in terms of how we're positioned. And that's what we've done historically at TCW, is wait for those dislocations and lean in. As an example, in 2020, which we alluded to with the pandemic, we put $20 billion of credit to work in a few weeks because that gave us the spread widening opportunity. So we can't tell you exactly. This time will be different. We know that in terms of what the market will do, but the spreads eventually will widen, and you want to be liquid and be able to take advantage of that. Okay, now if I could just say something quickly, turning to private markets, which you asked about, and is there a bubble there? I don't think there's a bubble. A bubble, by definition, requires some massive imbalance between demand and supply, and I think actually those are relatively in check. We know there's going to be demand for private credit because there's demand for people to pick up some spread for sacrificing liquidity. People who have very long-term liabilities are willing to do that, and also they get to print lower volatility. We can debate whether or not that's real, but it is real from an accounting perspective for many of those institutions, like insurance companies. And from a supply perspective, we know it's going to continue to come because banks are withdrawing from providing that credit. So that's going to remain in balance. You have a second part of that question, which is, is there going to be a distress cycle? I think there will, and Bob and I would agree that, like, private credit as an asset class, most entrants, it's not true of the two of us, so we're statistical anomalies, but 95% of people came into this asset class post the global financial crisis. So actually, it really hasn't been through a distress cycle yet. And we don't know exactly what that's going to look like. But you brought up one very important thing that I really wanted to pick up on, which is that, and I know you agree because you guys have been public about it, the documentation has gotten weaker. And actually, private credit as an asset class, the covenant is the asset class. It is the ultimate hedge. It is the thing that is supposed to distinguish private credit from other asset classes. You actually get a do-over. It is the only asset class where the capital provider is able to really dictate terms to the capital user. And if they deviate from those terms from a performance perspective, you get to take economics. In the extreme, you actually get to take control of the company. And I think what we're going to find is that people gave that away for free. And they did that because they were focused on deployment of capital over the discipline of the process. And what we're going to see in the next couple of years is some accidents related to that. It's not a bubble for the asset class, but we expect there to be a rise in defaults. And I think the main driver of that is going to be covenants. And of course, the secondary one is that we have a math problem because people put capital structures in place with the expectation that rates were going to stay zero, and they didn't. And now math is taking over.
Yeah, all very well said. I mean, there have been three real big dislocations over the last 40 years. One in the early 90s around the Gulf War recession, one around the dot-com blow-up, and then, of course, the financial crisis. All of those were marked by at least double-digit defaults. I'm not sure we get to that level this time, but even if you get back to sort of the historical norm for high yield and leveraged loans, which is around 4%, you're going to get a very, very significant amount of activity because, of course, that's operating on a much larger amount of debt than it was, even 10 years ago. I do agree private credit is better underwritten than the syndicated loan market. The syndicated loan market, I think, is the locus of the most egregious stuff that happened. I think that will be very interesting to see how it plays out, because I'm not sure everybody is fully aware how bad it can get with some of the documents that have been put in place.
Well, and you said something earlier, Bob, that you think that there are a number of companies that would have defaulted at this point if it hadn't been for how loose some of those covenants were, that are kind of hanging on because of the benevolence of investors who don't want to take the losses yet. I'm extrapolating there. I'm putting words in your mouth. You can correct me. But I'm wondering how much you think that has delayed a credit cycle, how much that has masked some of the distress under the hood that otherwise would have come to the fore in higher defaults and more companies looking for workouts.
If you use that 4% as kind of the historical average, we're sort of in the low twos in high yield and the high twos in loans when you add in what they call selective default, which is where a company undergoes some sort of liability management. That number is generally growing, but it's not spiking. It's just easing up. I do think, again, you're getting to the point of no return, especially for a couple of these floating rate structures where they're bridging themselves by issuing more debt. And at some point, even if rates go down, it's not going to be able to be recovered. But this time around, I think, again, the latitude that sponsors have in the documents, combined with the willingness of those sponsors, because again, if you go back 5 or 10 years ago, sponsors were more reticent to participate in this sort of activity. That's gone. So you have the combination of bad documents with aggressive sponsors, and I think that combination is going to result in a tremendous level of liability management over the next year and a half.
I would just add to that, actually in private credit, defaults went down in the first quarter, which would be very against people's expectations. But it's because last year we had 3 to 4 times the normal amendments for private credit as an asset class. So those are delayed defaults because you can't amend and pretend forever, and the longer rates stay where they are, the more people are going to have to make real decisions around those credits.
Both of you are interested in some sort of rescue financing, distressed investing. What does that look like at a time where the distress is kind of hidden and it's sort of hard to know exactly what's a good opportunity versus a company that hasn't truly been tested yet?
Yeah, I would just say in general, as private credit becomes a more prevalent asset class, there are a few things I would look for in your manager broadly, and it's true to rescue, and then I'll turn over to you, and I'm happy to talk about some of our investments specifically in rescue. But the first is looking for people who have long track records. So long track records are better than shorter ones. So you ideally want to invest with people who have been through a couple of recessions. I know we have a 23-year track record of doing it, and all of our MDs have invested in this asset class since before the financial crisis. The second is actually being conservative. So we've talked about debt levels, but just to give people a sense, if you focus on deployment over discipline, you're going to have not only given up the covenant, but you're going to have underwritten very high debt levels. And we have underwritten to 3 to 4 times debt to EBITDA, and I don't think the market's probably been there since 2012. So that's something to look for. And I'll tie this back to rescue in a second. And the third is diversification, which we haven't talked about. I just want to highlight to people that our clients, are LPs in general, are waking up to the fact that they're in a lot of the same loans. So we have a lot of the same managers when they go and look at, and there's a default issue. No one cared about this when companies weren't defaulting. But now that we're going to have defaults, people are waking up to the fact that they're in managers that have underwritten the same company. And it happens, it's a more tightly syndicated market than private equity. So it's unusual to have lots of the same private equity investments across your managers, but we're going to find out that that's true in credit. And we really pride ourselves at TCW as providing a diversified credit to our clients because of being very focused on the middle market area, staying away. We had stayed away from healthcare and technology and just provided diversified credit to the portfolio. So I want to say that those are things that people focus on. On rescue, in general, this is going to be, in our view, one of the greatest opportunities of the next decade is to come in as a private investor and provide capital solutions to companies that are struggling, not necessarily because they have a fundamental problem, and you would even have more perspective on that. You have a very storied history in distressed investing, but because they have a math problem. And so we have an unbelievable pipeline of companies to provide rescue finance for, and I think you're not going to see a pitch this wide for a long time.
Yeah, rescue financings for us are when a company meets a financial obligation of some form that they can no longer address through the syndicated market, either the syndicated high yield or the syndicated leveraged loan market. At that point, they have to turn to an alternative provider. And then at that point, that you can negotiate terms that are more advantageous than what is normal. I'd say that rescue financing opportunity is made better by the fact of the documentation. It's the flip side of what we just discussed, which is that if you're willing to step in and provide a solution to the sponsor when they're looking for a bridge to a better day to get across some operational issues, you can do that on highly advantaged terms. And in our mind, I would completely concur with Katie. I think that is a very substantial opportunity in front of us. It's not like anything I've seen in my career. You're able to structure something that is advantaged in almost all respects relative to the existing capital structure and do it on very good terms. So we're pretty excited.
I'm just going to pick up on that and say whether we talked about public markets all the way to rescue, the main advice to clients is there's going to be an opportunity here to be a liquidity provider. And you want to be positioned in such a way that you can do that. Clearly in rescue finance or private, you can dictate more of your own terms. But even in public markets, you want to step in when others can't. And I do just want to say on liquidity, in public markets, we are going to have a problem with liquidity. Banks are able to hold as 70% as much inventory as they were pre-GFC, and the market has tripled. So whenever this event comes that we're kind of talking about here, there is going to be a liquidity crisis, I think, around that. And therein lies the opportunity for people who have stayed conservative, stayed liquid, and are able to step in and be that provider to public markets. And there's going to be a tremendous opportunity to do that in private markets, too.
So we're completely out of time. Yeah. But, Bob, I want to give you the last word. Are you in this place also where you are conservatively structured so that you could be a liquidity provider?
Yeah, I think what we look for is to be in a position where we can be countercyclical, where the market, and if you look at the average portfolio, it's a very pro-cyclical portfolio. We've had 15 years of just tremendous performance out of pro-cyclical assets, especially leveraged pro-cyclical assets. And I think there'll come a point in time. It's been delayed longer than I would have expected, but I do think there'll be a point in time where being countercyclical will definitely inure to the benefit of that counterparty. So
I could talk to you both all day. Thank you so much for being with us. Bob, Katie, thank you. This really was fantastic.
Please welcome to the stage Ryan McCormick, Senior Factor and Core Equity Strategist at Invesco, with Bloomberg's Michelle Lynn.
One thing she's thinking about is the endowment push, and maybe that's a way of doing the reporting around Israel as well as finance. And so is there...
Michelle Lynn, Global Head of Data Science and Insight for the Bloomberg Media Organization. Hello? Is that working now? Okay. Once again, you know who I am. I'm Michelle Lynn, Global Head of Data Science and Insight for the Bloomberg Media Organization, and I'm joined by Ryan McCormick, Senior Factor and Core Equity Strategist for Invesco QQQ, Sponsor Spotlight, Rethinking Innovation. Ryan, thank you so much for being with us here today.
Oh, thanks for having me.
Should we jump right in?
Yeah, please.
Okay, so as a reminder for everyone, can you tell us what QQQ is?
Yeah, so QQQ is an ETF. It's one of kind of the oldest ETFs in the U.S., 25 years old. And it tracks the NASDAQ 100 index, which is comprised of just the 100 largest companies listed on the NASDAQ exchange, ex-financials. Over these 25 years, it's blossomed into the fifth largest ETF in the world. It's the second most actively traded ETF in the world. And just gives investors an easy way to access 100 of these very innovative and sort of growth-oriented names.
So has the appetite for investing in innovation grown?
Yeah, I think the appetite for innovation in general, right? Like particularly in the past 5 years, you can even go 10 or 15, it's grown considerably. I mean, not only through the flows and interest that we've seen in the ETF itself, but sort of the way that folks look at the ETF. I think initially there's been sort of this misnomer that QQQ is just a basket of technology companies, which is about half correct. But you look at, you can almost like massage the wording into like more technologically oriented companies. So maybe not specifically designated within the tech sector, but certainly running tech adjacent. But we look back to try to figure out, well, what has made these companies really successful? Like, why have they been able to change and innovate and continually push the envelope? And, we've found some common characteristics within these companies that I think have allowed them to grow fundamentals as much as they have for the past 2 decades plus. And it sort of starts with the fact that they invest more in things like research and development, which leads to really considerable patent activity. So they're filing a huge percentage of patents across a number of different disruptive technologies. And for us, like, that consistent reinvestment back into their business is the thing that drives fundamentals and ultimately performance.
And how has that benefited QQQ?
Well, I think the fact that it's been around for as long as it has, the performance that it's shown. I mean, there's a lot of investor familiarity with the fund. There's a lot of notoriety. I think with it, we've been able to sort of engage in a number of different marketing opportunities, things like Bloomberg Invest, which is one of my favorite events in the year, or like we're the official ETF of March Madness, right? So if any of you watch the NCAA basketball tournament, like, I challenge you to go maybe 5 minutes without seeing a commercial with Invesco QQQ, right? So I think there's this level of familiarity, not only for the names and performance, but now kind of just being a partner with financial organizations and investors being aware of kind of what QQQ is about.
So you've been delivering access to innovation for quite a while.
Yeah, so delivering access to innovation for about 25 years. We just celebrated in March our 25th anniversary for the fund being live. I think that was an important point because it was still in the early stages of ETFs, right, where it's providing access to individual investors that wasn't really around before. And I think maybe initially it was sort of more institutionally geared, but over these 25 years, I mean, we've seen a number of different institutions using QQQ. We've seen financial advisors on behalf of their clients use the Qs, and now more and more the self-directed investor. Just the ease and accessibility of brokerage platforms these days. I mean, they're getting access to strategies that 10 or 20 years ago, there wasn't really a possibility.
Well, Ryan, thank you so much for sharing your insights with us on innovation as part of the Invesco QQQ Sponsor Spotlight.
Thanks so much, Michelle.
Please welcome to the stage Edwin Cass, Chief Investment Officer of CPP Investments, and Kim Liu, President and CEO of Columbia Investment Management Company with Bloomberg's Manus Cranny.
Good morning, everybody. It's interesting. I sort of get up every day at 2:30 a.m. and the first thing that I do is obviously check what price NVIDIA is and check where we are in the frenzy mode of our lives. These are long-term investors. They don't do anything so scurrilous as check the price of NVIDIA every morning. But Kim and Edwin, welcome. There does seem to be a bit of a frenzy in public markets and a distinct sense of angst in the private markets. How much comfort do you have leaning into private markets? Ladies first. Kim, good morning.
Good morning. Thank you. It's a pleasure to be here. I think that despite what's happening, as long-term investors, you sort of look through this moment to the opportunity set over the long term. And I think if you just focus on the U.S. markets right now, we used to have 8,000 stocks in the public market, and now we're down to 4,500 stocks in the market. And I think it's something like 87% of companies with sales over $100 million are private. So I think it would be impossible for us to ignore private markets and not think that there's a large opportunity set. I think that the way we think about investing in private markets and the way we approach it is different than you might have done in public markets. I often say, we joked about it, that public markets is dating and private markets is getting married. And so you have to approach it and you have to do it very differently. You have to be thoughtful about these relationships because, for sure, if it doesn't work out, you have kids together and you have to figure out how to manage those relationships. And so I think that being thoughtful about how we engage in the private markets is increasingly a pressure among private investors, especially now that interest rates have gone up. I've been in this business long enough that these rates don't feel so high to me, but it does feel extremely high to my team. And so trying to pay attention to how the valuations have to reset before, once again, we can make a lot of money. But I have high hopes that we will continue to make a lot of money in the private markets.
Yeah, I think maybe when I got my first mortgage, it was 1994. And that was like at 5.5% in the UK. But my brother was even more tortured at 15%. Hopefully we don't go back there. Good morning to you, Edwin. Are you dating or committed? Where are you in public versus private markets?
No, very interesting question. When we think about public versus private markets, the first question for me is, do you get any kind of diversification by going into private markets, diversification benefit? And for most private assets, we think they load on generally the same kind of factors that public assets load on. So if you think of private equity to us is like leveraged small cap. If that's true, then you're really not getting a diversification benefit. You have to look to something else, and that something else has traditionally been alpha. And you can think about all the different sources of generating alpha from private markets, whether it's origination networks or value creation plans or just the ability to kind of pick better securities through access to private markets. And we think there's still a positive expectation in terms of the comparative advantages that we've built up to invest in private markets that gives us an impetus to push into the asset class. But I think there's one really interesting feature that's going on right now, and obviously you alluded to the start, is kind of NVIDIA and what's going on with NVIDIA. To the extent you're diversifying into private markets, you're getting away from public markets, you're getting away through the ability to access some of those huge growth engines like NVIDIA. And the one thing we've been challenging ourselves lately is, could you predict that this was going to happen? Or how would you protect yourself against this happening if you didn't have that kind of exposure? Generally, concentration in a market, in a portfolio, of course, is really bad. But there's also this big kind of winner-take-all theme going through the markets right now. Does that persist? Do you think the conditions exist right now that can kind of feed off itself?
Well, that winner-takes-all narrative, I mean, am I correct in assuming that winner-takes-all comes down to the great AI, sort of the banner? If you stick AI on the side of it, suddenly it has a new narrative. I mean, to that extent, Kim, how do you think about AI? Because various people are sort of saying, look, we're in the foothills of development of what AI is. We don't really understand the full potential, the implementation process, nor indeed the cost. It's a big, big subject. But what does it mean to you?
Yeah, I think that it would be irresponsible for us to ignore the AI revolution. I think that as much as there is a lot of short-term hype, I think long-term it has the potential to be transformative. And so we are spending a lot of time thinking about what elements of it are structurally have barriers to entry. And so there is a winner-take-all element to that and which don't. And it seems to me that things like chips, things like infrastructure and systems has a little bit of that because NVIDIA is so far ahead, it's expensive to catch up. There's, the technology that it requires to build these chips are sort of based in Taiwan, and we talked about the risk of that and the global risk of so much being based in Taiwan. But what we're seeing is that some of the apps and some of the applications, there are no barriers to entry, right? Like, it's fairly easy to come up with, and I don't mean to belittle the complexity of it, but there are not moats around those things like they used to. So I think that there is less of a winner-take-all in that space. You're going to have to earn that spot, whereas it'll be fun to watch what happens. And I think there's going to be a lot of money burned in the process. because somebody will develop something and a fast follower will come along and make it better and cheaper because data gets cheaper and more pervasive, and it's going to be easy for new players to come in and do interesting things. So I think we wait and we see. But that's exactly why they'll
But does
be
it force
able
a
to make
sense
money.
of, does it, I mean, as you say, you look across it, you see there's certain moats around some organizations and some companies, NVIDIA being one of them is the theory. But does it force a sense of FOMO, even though you say to me, oh, I am a long-term investor, we're structural, we look for public and private markets. I mean, we look at these moves and we look at the scale of some of these individual names, and it does force a sense of, I hope that pension fund of mine has a little bit more NVIDIA in it relative to everything else on the longer term. Does it invoke a sense of FOMO in you? What does it do to your thinking?
At a behavioral science level, yeah, absolutely, it's a sense of FOMO. I think it's tough to deny that. I think the challenge, the way I've presented it to our people internally is, can we learn anything from it? Are there any signposts or any guides that would have indicated that, hey, this was going to happen, that you could have positioned yourself for it, that you could have anticipated it? Mm-hmm. Does it force a rethinking of something like a private-public split?
Yeah.
Where you're going to allocate capital. It absolutely kills me that a relatively naive portfolio, if you just invested your money in the public markets on an index weight basis and did a 65-35 split between equities and bonds, it probably beat most of the more sophisticated portfolios that you could have designed over the last 10 or 15 years. It was a great article in the Wall Street Journal, I think it was a week ago, talking about the bear market and diversification. And diversification is something I truly believe in, and yet most pushes into diversified portfolios over the last 20 years have underperformed.
Very quickly before we go to the poll, I want to involve the audience here. Every morning at 5 a.m. you will hear me say it's going to be the year of the bond soon. In theory, that is coming. Very quickly, to what extent do bonds now play a smart role, an additional role for you in allocation? If you briefly answer that, and then we'll ask the poll question. Kim.
I think for a long time we weren't receiving a return on bonds that was sufficient, and so people were shying away and going into more risky strategies because the payout that we had to make didn't change. We were sort of locked in somewhere between a 5 and a 7% payout for most people in the U.S. in the foundation and endowment space, and so we weren't doing bonds. You know, interest rates obviously are up a lot, and you can do a lot more. And I think that particularly now, there's a lot of challenges around liquidity because the private markets are not distributing anything, and so people want to find ways to get more liquid. So I think for sure there's just greater interest in figuring out how bonds can play a different role. But we also know that it doesn't provide the diversification benefit it used to provide. It used to be negatively correlated with the equity markets, and now it's just low correlation to the equity markets. And so we have to think about that a little differently as well.
Edwin, I know it's sort of a short squeeze to try and sort of force either people like you to answer this and the role of bonds within a portfolio, but has it shifted? Because it has been a fairly tough 3 years in that space, and now we worry about fiscal probity going into 2025, and that challenges long-term duration, doesn't it?
Kim kind of alluded to the problem. I think there's two classes of investors. There's investors that are return-oriented, and there's investors that are risk-oriented. And certainly for a return-oriented investor, a lot of the period over the last 10 years, bonds weren't attractive because of the low yields. We're a risk-oriented investor in the sense that we target a level of risk and we try to maximize return of that level of risk. So for us, the key question, and again, Kim alluded to it, was are bonds a diversifier to equities or are they positively correlated to equities? And certainly our thinking there has shifted. I can go into technical reasons, but over the last couple of years, we think bonds have lost a bit of that diversifying property, so our appetite is probably down a little from where it was. But we still think, like, on a longer-term time horizon, that bonds can be an effective diversifier of equities. So they do play a part in portfolio construction, maybe just not as big a part as they've played in the past.
So I'm on the phone afterwards straight away for some 5 years and a little bit more NVIDIA. Let's ask the poll question now. Sorry, I front run myself. For you, the audience, here's the results. We asked you, what's the best opportunity set at the moment? And the options were traditional assets, bonds and stocks, alternative infrastructure, private credit, international markets, 29%. And nowhere, I'm keeping the money in cash. Well, that's good news for the asset management and the global investment community. You're deploying and they will earn. Alternatives and infrastructure, private debt and real estate. It's a broad church up there within those alternatives at 35%. But let's just deal with some of that, because within that, we have this debate between private equity, which has got a lot of assets in it, and it's finding it tough to find the exit point. That's using perhaps some private credit to help them with the payouts, and some people are saying that's a hidden issue for us, and it's a growing issue. Kim, for you, the blockage to entry for private equity, how much of a challenge is that for endowments like you?
So I think it's been traditionally foundations and endowments particularly have had a huge allocation to privates, not just private equity and real estate, but also venture. And that has been a huge whipsawing, both with extraordinarily good performance and then extraordinarily poor performance. And I think, but more importantly, it's locked up liquidity. Yeah. And it's made it, and now it's put more pressure on your marketables book to produce the payout that you need each year, right? So, you think about a 5% payout, but if 50% of your book is not generating anything, that means it's a 10% payout for your liquid part of your book, and you have to think about it that way. I think so. As a result, people are trying to figure out how to make sure that their privates book are not negative cash flow, right? And so they have to put cash-generating assets in their private book. So private debt became very attractive. Obviously, with yields up, it gave more opportunity for people to generate a return. I think there are lots of skillful players. There's a lot of capital in that space. The story will be yet to be told. Everybody's waiting for the dislocation that will make that a phenomenal asset class instead of a good asset class and reward you for the risk that you're taking, yes. Which that's the question. Are you being rewarded for the risk you're taking? Because we think about it in terms of risk as well. It's not clear.
Edwin, is that reward challenged? I mean, are you worried about this blockage in private equity? I mean, some tech exits are happening, but it is a tough world at the moment to get these exits. There's trapped capital, I understand, of over $3.2 trillion in private equity.
Again, we kind of think about it on a longer-term time horizon, not a kind of tactical horizon. And for us, the key thing is if you have an appetite for private assets and it's, say, conditional upon being able to generate some alpha, then how much of your portfolio can you allocate to privates? So we kind of start there and we say, how much of our portfolio do you want in privates? That's driven by liquidity, as Kim suggests. You have to think about what your needs of your demands for liquidity are. If you're an endowment, you have a certain payout ratio. We're in a lucky position that we don't have demands for liquidity except over a very long time horizon. So for us, it's more around things like being able to meet margin calls, being able to rebalance our portfolio, being able to hold dry powder in case there's really interesting opportunities. So we kind of turn it on its head and say, how big can that private portfolio be? For us, it's kind of like 3/4 to 4/5 of our portfolio. And then think about how we want to allocate internally within that pool to the best opportunities.
Briefly before I move on, because time is against us, do either of you have any considerable concern around the area of private credit, whether it's fully disclosed, whether it's robustly managed? Are you worried about anything in private credit? Briefly, Kim.
Look, I think markets are eternally optimistic, and they assume that the best outcome will happen, and we haven't had huge defaults in a long time, and so it'll be interesting to see when we actually do. I grew up in private credit at a time when there were really amazing workout people, and there's been no workouts to work out. So it'll be interesting to see what happens if we actually have defaults and whether the skills exist within these firms to manage through those situations. So I think there's a lot of just structural organizational things that'll be interesting in the private credit space.
When the tide goes out?
Yeah. Edwin? So we're in a default cycle right now. I think that's
rolling defaults, I feel like.
Yeah. I think most people are missing that. But if you take a look at watch lists are 10 times the size that were roughly 3 or 4 years ago. So we're in the middle of the cycle now. I think what it'll expose is who did good underwriting, who did bad underwriting. A lot of I shouldn't say a lot. There's definitely players in the space that were more chasing AUM than chasing great investments, and we have to see how that plays out. We've been involved in private credit for a very long period of time. We bought a company called Antares out of GE. They have a sparkling underwriting record over a period of multi-decades. We think we're in good shape, but it'll be I think there'll be some players that don't fare as well as we work our way through.
In the best spirit of a short on-stage 20 minutes, you've got a minute each to give me a quick answer on deglobalization and the risk. Very, very briefly, does it enter your zeitgeist? Li Qiang in China this morning talked about a decoupling will lead to destructive spiral. To what extent, Kim, is global deglobalization something that you think about?
I think we do think about it quite a lot. I think a lot of the thoughts around, that underpin how we portfolio constructs assumes that everybody is trying to manage towards the lowest cost structure possible, and now that's different, right? It's also inflationary, so there's a lot that's going on that way, and it also increases the risk of wars, right? The more we decouple from each other. So all that creates risk that we haven't historically had to price in, or at least in the same way. So I think that it definitely has an impact on how we will think about these markets, and I think it's going to be tricky because it's not going to be clear for a while.
Certainly, it might get even murkier if we go into 2025. To close, Edwin, your view.
Well, I think Kim alluded to it, but again, if you have deglobalization, you have the chance for some very bad outcomes and some very narrow regional spaces. The best way to protect yourself against that is to be well diversified across a number of investments, a number of different geographies, a number of different power blocks. We haven't seen that shoe drop in the sense that if you think about deglobalization and the costs imposed upon the system, it really should hit GDP. But we haven't seen huge revisions to GDP estimates going forward. And I think partly that's because global trade hasn't taken a hit right now. I mean, people talk about deglobalization, but if you take a look at trade stats aren't showing that as yet throughout the system.
Okay, it's going to be a question of show and tell. Ladies and gentlemen, diversify. You're only 19% diversified, so take that away from the poll. To my panel this morning, thank you to Edwin Cass, Chief Investment Officer at CPP, and to Kim Liu, President and CEO of Columbia Investment Management.
I'm concerned that a sell-off for fundamental reasons may actually become exacerbated for technical reasons.
Please welcome to the stage Boaz Weinstein, founder and chief investment officer of Saba Capital Management, with Bloomberg's Shanali Bassick.
You might have known Boaz Weinstein back in the day for taking on the JP Morgan London whale, and of course he's been known for many, many years out of the credit world because, of course, he invests in very complicated credit assets. But more recently, he's been known as an activist investor. You have been most recently, after for a while targeting a series of closed-end funds, very, let's say, aggressively going after BlackRock. There have been lawsuits and, of course, proxy battles. We're actually in the center of a proxy battle right now, with certain funds actually have already been voted on over the last couple of weeks. What we don't know, and what is a very important thing, you've been very vocal on Twitter usually on how these battles are going. You've been pretty quiet. How have the meetings gone? Have you won anything?
So it's always nice to aspire to break news on a conference like this, and it so happens that the fund that has gotten the most of my attention, which is called Big Z, B-I-G-Z, just had the voting close at 11 o'clock. So I can say preliminarily, I didn't count the votes, but they've announced it, that actually all the Saba nominees, there were 7, got more votes than all of the BlackRock nominees, and 4 of our nominees got more than 2 times as many votes as BlackRock, so more than 2 to 1. And when you win an election by 2 to 1, the voters have spoken. You know, we all know landslide is like 60-40, 58-42. If more than 2/3 voted one way, you know, BlackRock can no longer say that they purport to speak for the shareholder and try to create some divisions. The shareholder has spoken. We won. And the reason that there's been litigation, it's been outward, it's us to them, is because they have put in place election rules that would make Vladimir Putin blush.
So let's step back, big step back. This is one fund you said you were voting for today, but there are 10 funds.
Mm-hmm.
Ultimately, what is it that you want out of this strategy? These are closed-end funds, so you're locking up, or BlackRock has locked up capital for a longer period of time, forever, right, in many of these funds. So what is it that you're trying to accomplish by targeting them? I understand that you target them when they're trading below their net asset value. You want them to bring investors whole. But what's the end game here? You won at one fund. What else do you want?
Yeah, so ETFs, as we all know, can be sold at net asset value, or the market maker can redeem them for net asset value. And then the manager, BlackRock, will go and sell the assets and give back net asset value. Closed-end funds, you're trapped. Many of these funds have no maturity. They could be around for 100 years, 200 years. And so there are periods where the investors don't want them. And for some reason, there isn't a manager more than BlackRock that the investors don't want. It's nothing personal. I'm not looking to not be besties with Larry Fink. I'm not looking to be besties with Larry Fink. I basically am just looking to make my investors money. And if the discounts are persistent and they're there year after year and you can buy it a literal dollar for 85 cents, you have the power, unlike in normal activism, to turn that back into a dollar. Because if you change the fund structure to being an open-ended fund, like an ETF or a mutual fund, or the manager agrees to buy back shares at net asset value, just like Franklin Templeton did this month in 3 energy funds, the investor has a chance to go from 85 to 100. And as you all know, that's not even just 15%, because it's 15 over 85. That's an 18% return. Big Z today is at greater than a 15% discount. And it's a fund that lit its investors' money on fire. Now, I say that, it sounds dramatic. The last 3 years, we've been in more or less a bull market, not for everything. But Big Z has lost more than 50% of its capital from the stock prices going down and from the discounts going up. And so it's lost billions of dollars. And here we have investors resoundingly saying, we want change at the board level. But the part that many of you would be shocked to hear, why I mentioned that quip about Putin, is that they've decided to set election rules such that in order to replace their board, you have to actually get 50% of all the shares. Now, in Big Z, preliminarily, they got about 51 to vote, so we would have needed 50 out of 51. Okay, winning 35 to 15 wasn't good enough. And so that kind of math makes it literally impossible, but ironically, it makes it impossible for them to put anyone else on the board, because they would have to go through their own arcane rules. And so as a result, the BlackRock nominees each sit on approximately 70 boards. 70 different boards. How can they do their job at 70 boards? At JP Morgan, each nominee sits on one board. It's horrific governance from a firm that's an incredible firm that actually prides itself in raising money to invest in good governance.
Now, I think importantly, as we've mentioned, this is one fund that you know the outcome for. Yes, it's a big fund for you to be investing in with a large discount, but what about the rest of them? If you were to be on course to lose, how would you react?
Right.
Do you know anything about those votes?
Right. So I can't announce what's going to happen for the other big funds. Big Z is something like $1.7 billion. It's really large. And that's also why this has captivated the media's attention and also individual investors. There's a lot of money at stake. Going to NAV just a few weeks ago was worth $1.4 billion to mostly mom-and-pop investors and to our investors, who include mom-and-pop. We manage money in these very strategies for 3 different state pensions, millions of pensioners. So the results are in limbo, even if we win, because it depends what the judge says. We've taken them to court this year for this election scheme. And last year we did it for a different election scheme, and we won in summary judgment against BlackRock, against Nuveen, and I have a lot of respect for our panelists from the last session from Nuveen. But BlackRock, to be fair, is not the only one, but they are by far the worst. And it's those legal victories that have helped us in order to get good results with other managers who don't want to be on the wrong side of the law. And so that's why this year I was very proud that we won Institutional Investor Activist of the Year back-to-back years. And no closed-end fund activist has ever won it before, and we were voted the best activist according to Institutional Investor.
You're no longer just a closed-end fund activist. You're also a closed-end fund manager, given that you've taken over some funds. And those funds are actually not trading at asset value. So how then do you turn around and attack BlackRock when your own funds are trading at a discount?
So firstly, there's two measures. Let's say there's how they performed. How much money did investors make or lose? You mentioned there's a lot of BlackRock funds where we went after. There are 10. 9 of them, the last 3 years, have lost investors' money. 9 out of 10. Think about the market we're in, where the S&P is, even where the Russell is. 9 out of 10 are in the red. Our fund that we've been managing for 2.5 years, that fund has actually made quite a bit of money. And in 2022, the first year we managed it, it was ranked number 1 out of 257 funds where the motive was income-based funds, and we came in first. So BlackRock can say, well, their fund trades at a discount too, but what they leave aside, this is the rub, Sonali, is that we, when we took it over, said to the investors, if you want to get out at NAV or close to NAV, we will let you. We conducted a tender. And then there were more people that wanted to get out, kind of like, looking at it from capturing that discount, and we did a second tender. So we let investors out of 45%. 45% of the capital exited, and we let them out of NAV. BlackRock is not willing to do anything like that.
One critique I've heard you make is the idea of lowering fees here to attract more investment. But for these funds, they tend to run at higher fees than the ETF structure. Would you consider lowering fees for your own funds?
Right. So our fund that we took over in January, the ticker is SABA, is one of the lowest fee funds in the marketplace. It only charges 75 basis points. The other fund is more normal. It charges right around 1%. But it's also you get what you pay for. I think most investors appreciate that if the fund is going to do interesting things, you mentioned credit derivative wizardry or whatever you said in the beginning, and we are doing really neat things in those funds. We're not just putting together a long portfolio and letting it sit. And so I think our fees are actually very modest. It's not for me to say. It's for the investors to say when you look at what you're getting.
Now, I want to read you BlackRock's statement because, of course, they have fought back. They have not let you just attack their funds. They said that BlackRock and the fund's boards remained focused on delivering value for all shareholders through concrete actions such as increased distributions and discount management programs. Saba is an activist hedge fund looking to arbitrage funds to capture quick profits. This attack is not about government's performance or discounts. It is about executing Saba's well-known playbook, buying controlling positions, and forcing short-term changes that harm retail investors to benefit Saba and its hedge fund investors. What is your response to that? And what do you do after these campaigns?
Yeah. When I sit here and think, throw your best at me, Sonali. Like, they send you a question, just please, give me your toughest question. I'm not here to be, we don't have some friendly arrangement. Ask me anything you want. I fear none of their questions because they're so absurd, okay? When they say that we're using some purported playbook to help investors in the short term, where is the long-term pain of making investors money? Usually when you say you have a short-term motive, there's a long-term consequence. Having the funds have investors have a chance to get out at full value, where is the negative in that? And I'm not going to use my words, okay? ISS, which is independent, okay, which stands to tell the small investor how they should view this kind of rough contest that we're having. Here's what ISS said about this year, okay? The board is deeply entrenched. A direct intervention remains necessary. It is rare to witness a board so brazenly flout the most basic of shareholder rights in furtherance of their own enrichment. I'll read one more. The board actions are so grave that they would warrant adverse vote for incumbents in an uncontested election. What ISS has said is that even if we didn't run against BlackRock, they would have recommended against their nominees. That is literally how bad it is. And I want to just say, BlackRock's an amazing firm. They manage $10.5 trillion by last account. This might be big to us. This might be very big to our investors. This is tiny, small potatoes. And it will someday be a case study at HBS of a strategy failure. That for $5 billion of action, of buying back funds at a discount, including their own employees who would get to make that money, including their shareholders, that they would say, look, we actually care about you. We're going to treat you the way other managers are treating their shareholders. They wouldn't have this problem on their hands. They have amazing products, but for closed-end funds, they basically have taken the position, no one is going to tell us what to do, and we're willing to do whatever it takes to squash the rights of the shareholder, which is enshrined in the 40 Act. The 40 Act is there, the 1940 Act, the Investment Company Act, is there to protect small investors. They don't need the same protections in ETFs because you can vote with your feet. You can redeem a mutual fund. You can sell an ETF at NAV. But they are violating the Investment Company Act. Don't trust my words. a judge said it last year, and we won our case.
What is your end game here? Because in addition to, yes, they did support you on the director push, but they did not support you, ISS that is, to terminate BlackRock as the investment advisor. Is your ultimate end game to take over these funds?
So we've been in, this is not my first rodeo, we've been in about, 80 campaigns. And across 80 campaigns, only 2 times did the end result come that we took it over. In the first case, actually, the manager resigned. They said, we'll stay on as manager until you can find a new manager. So we don't come into it with that goal. We come into it with the goal of making our investors money, and it turns out all shareholders get to make the same amount of money. They don't have to pay the legal fees that we're paying. And by the way, BlackRock has sent tons of mailers. You saw the Chiron, you saw the graphic, Saba is trying to destroy your fund. That mailer went out 4 or 5 times, robocalls, on and on. I actually receive them because I'm a personal shareholder. I receive these robocalls and these mailers. And what's amazing, in the case of Big Z, that's the only one I can talk about, they only got 1 out of 7 shareholders to vote for them. I mean, it's just incredible. That's despite so what is my end goal? My end goal is to turn these funds back to NAV and make everyone $1.3 billion, not because I'm some sort of management McKinsey wizard, because NAV is $1.3 billion away.
Has this gotten personal?
I mean, I definitely, I definitely am feeling it on the stage, right? But no, it's really, you know what it is? I have my pet peeve is, this is going to sound a little corny, is injustice. Okay, everyone has their own. It's abusive, and so I just, having been doing this, having been in 80 campaigns before, I just haven't seen it. We actually decided this past year, in year 2 of this craziness, to launch a fund dedicated to the closed-end funds of a single manager. Okay, we didn't say we're going to pick BlackRock. We looked at the attributes. What are the funds that are at the biggest discounts? What are the funds that have the worst governance? I should say those 2 funds you mentioned that we run, we put in place the best governance. ISS agrees. We put in place governance where you count the number of votes, not the number of whatever that, how do you even know to describe that you need half of all the shares to be voted in your favor, even if half don't even show up. So all of those things, annual elections instead of staggered elections, it is only personal in the sense that it to me violates, we're so lucky in this business, the amount of money that management firms make. They have $10.5 trillion to do this because they want to trap capital. They're basically blinded by this being long-term capital that cannot be redeemed, and they want to hold on to it. And so, to me, it's like a very noble fight, and we've received, you can just look on Twitter, hundreds and hundreds of positive comments, and basically not one negative comment. So I do enjoy the retail coming along for the ride. Yes, in that sense, it's personal.
So, also to be clear, this is an investment strategy. This is a strategy that is meant to return money to shareholders. It's not just on concept. How profitable is it? And how big of a strategy has it become? Has Saba really pivoted from becoming a tail fund to an activist fund?
Well, give me a tail event, and I'll be a tail fund manager again. But we've had what have we had, like 40 straight days of the S&P not going down even 0.75%. It is a big business for us. We own $6 billion of closed-end funds. A full third of them are just this single manager, BlackRock, and many of them we think have good governance. They just are at discounts. We don't have a governance issue. So it is quite a big business for us, and I can't really on this stage speak to the returns, but we have an ETF, for example. The ticker is CEFS. It's been around for more than 7 years, and people can plug in how that did versus the 3 other ETFs that own closed-end funds. It's done very well.
How well?
All right, well, if someone were to plug it into Bloomberg and they put CEFS and then they put the Invesco version or the First Trust version, I think for the last 3 years, and it's held, a lot of it's been in fixed income, which has had a tough time. Those other funds have made between 0 and 2%, and we've made 10%.
So let's broaden out here again, because people have looked at you for credit markets for a long time. When we talk about the closed-end fund strategy, there's a deeper question. It's not really just about closed-end funds. There's a whole push by the private asset industry to push into retail, to push into interval funds, to find new strategies to bring money in. Are all of those funds vulnerable to activists?
So by the laws of depending on the structure, some are, some are not. In the interval fund, generally you only have the right to redeem 5%, so you're getting 5% back per quarter, but you can't, they also invest generally in deeply illiquid assets, so you couldn't just sell Microsoft or IBM and raise the cash. So It is interesting for me, as having been in credit at the forefront of all the innovation that came after 1998 with credit derivatives and synthetic securitization and all of this sort of stuff. And back then, retail investors were deemed unsuitable to own these things. You couldn't own high yield, really, if you were not a qualified investor. And now, whether it's CLO tranches, alphabet soup. And so this has been an amazing boom for the largest asset managers, the amazing managers like an Ares or Apollo that can bring these products, their reputations, and good governance, I should say, because we also see a lot of very good governance. JP Morgan has great governance on their closed-end funds. And we see that there is huge investor demand. The private credit space was a cottage industry a decade ago at less than $250 billion. Now it's $1.5 trillion, and it's growing like gangbusters. So this kind of illiquid credit investing that you're referring to allows the manager to lock up for many years. It's great for their stock price. It may be great for their investors, but we are in a little bit of a zero-sum world. Like, if making loans that are secured, that are safe, that have a lot of asset coverage at 12% or 13% is great for Ares, it probably ain't great for the borrower, especially in this higher for longer world. So just to close on that, just to say, I think people, just even 3 months ago, were really expecting rates to come down and that 13 to go to 12, 11, 10 and really alleviate that pressure. But I think higher for longer, we're headed for some sort of collision course between, if we have that in conjunction with an economic slowdown, we are going to have a default cycle. We are going to see which firms were good at private credit and which were not. Because private credit has been touted as this amazing thing, almost like NFTs or ChatGPT. I mean, what is private credit? You're making loans to smaller companies. I mean, how is that sexy? No, So, but it's very sexy for Ares and Apollo, and I look at it like this amazing force that will have hiccups in the years to come.
Now, one more question for you before I let you go is, we have a major catalyst around the corner, that is the U.S. presidential election. As a massive investor in credit, and also as somebody who looks at volatility very closely, what are you thinking about headed into that election cycle and what comes out of it, how to position?
Yeah, so, it's coming closer every day, and it warrants our attention. And we'll also, if there's a change in the presidency, you'll have a president that people consider as someone that will be will be more unfettered, let's say, and maybe have scores to settle and have views about how to undo things. And so change generally means volatility. So it's really reflexive to think, okay, if Trump is elected, there'll be a lot of volatility. Now, he also is very interested in the stock market going up, which you usually think about in conjunction with lower volatility. So but might the ways he does that, whether it's a new Fed governor, cause some short-term gain for actual long-term pain, where interest rates in the front end come down, but in the back end go up, and certain firms are affected that way. As when I think through that Trump means volatility, the other side of me thinks back to 2017. We had Trump and we had Kim Jong-un, and he was calling him Rocket Man. He was kind of taunting him. And I remember during Rocket Man, it wasn't an Elton John reference, right? At that moment, the VIX hit single digits. The VIX was the all-time, it was at 9. I was crying because I'm a long volatility manager, and the VIX is literally at 9. And so, the Trump presidency is, if it happens, is going to be in many ways unpredictable. So you think there'll be volatility, but let's also remember there was also a lot of economic stability, though maybe because we were in a 0% interest rate world, and now having seen the excess of that and the inflation, maybe we're not going to go back to that world, and there'll be volatility whether Trump is elected or Biden is reelected.
Who's better for the bond market?
Biden.
Why?
Because I think he's less motivated by the stock market and more motivated by what's good for America. On the subject of bonds. I'm not getting that political. Just bonds.
We will leave it there. Boaz, thank you so much for taking all our questions. That is Boaz Weinstein of Saba Capital.
Please welcome to the stage Bloomberg's Mark Miller.
I'm the global editor of Bloomberg Live, which is the group that puts on events like this for the Bloomberg newsroom. So thank you all for being here. I'm also super excited to be here today because this is the launch day of the new reimagined monthly Bloomberg Businessweek magazine. It is literally hot off the press. And we have copies for many of you when you leave the event today. So please pick that up. It's been rethought in its monthly format. And of course, also rethought for the daily experience that you'll get on Bloomberg.com. One of the things that we do with Bloomberg Businessweek is work with them closely on a list that we call ones to watch in different industries. And here, in this industry, we looked across both established players and yet-to-be household names. And this is an important collaboration for both of us. So please give your attention to a video that we have, the ones to watch in banking, private equity, and asset management. You'll also receive a copy of the magazine where the ones to watch list is included. And as you can see, we have a very impressive group of people here. Block's Amrita Ahuja says that when our customers do well, our business does well. Her customers must be doing quite well because since she joined the company in 2019, adjusted earnings have more than quadrupled. Natalie Adame spent the last 3 years at Brookfield helping to build the world's biggest global energy transition fund. She's betting that countries pledging to achieve net zero emissions will drive greater demand for renewable energy sources. Darren Cohen is a driving force behind Goldman Sachs' $5.2 billion fund dedicated to investing in private companies, including Stripe and Canva. Mala Gonker, her company, SergoCap Partners, raised $1.8 billion when it started last year, making it the largest female-led hedge fund debut in history. In her spare time, she co-founded a think tank and a nonprofit focused on health, and she wrote a play with David Byrne. Apollo's Akila Grewal is a key player in their push to make private credit an asset class in every investor's portfolio, and you'll be hearing more from her shortly. Elise Colleen Stillmark is a unique firm that offers both institutional venture capital knowledge and expertise in Bitcoin technologies. At 35, Nick Lasser is one of the youngest fund managers to go it alone. With Lycos, he is expanding on the strategy he developed at Soros of investing in late-stage private companies and initial public offerings. Tim Spence is steering Fifth Third Bancorp, a 165-year-old Midwest bank, into the digital age, which is going to be crucial to their success as they navigate this rapidly changing environment. For McKinsey, Shelley Stewart, investing in improving lives go hand in hand. In addition to his work with corporate clients, he leads research for a think tank at the company to help advance racial equity. And at the beginning of the year, Bank of America's Savita Subramanian made a bold call predicting the S&P 500 would hit 5,400 by year end. So congratulations to everyone on the list. Whichever turn markets take, you will want to be watching this group of people and how they react to it. And now I'm delighted to welcome Bloomberg Businessweek Assistant Managing Editor Jim Ellis and one to watch Akila Grewal.
Good morning, and thanks for having us here. As you know, private credit is it's mushroomed to become one of the hottest, if not the hottest, sort of alternative investment in recent years. So I'm excited to have a conversation today with someone who is, I consider to be an expert in this, who is Akila Grewal, who is a partner at Apollo and also global head of credit product there. And she was named a partner last year. And she is what I like to call one of the evangelists of private credit, going out spreading the word about why and how this can be used as an asset class. Now, what interests me particularly about this is that private credit has sort of taken over the headlines, but I still consider it to be sort of a misty area for a lot of people. So I'm glad we have this conversation to talk about a little about it. Now, although the estimates say that, we're talking about a, $1.7 trillion business now, I still think that a lot of people are sort of new to this. Are you finding when you're talking to companies and investors about getting involved in this that there's still an educational process?
Yes, absolutely. There is definitely still investors who are, getting educated on what private credit is. I think you heard earlier, when we say private credit, when we say 1.7 trillion, we're really talking about mostly a direct lending kind of market, right? And that is sponsor-backed lending to small companies, as you heard kind of on the prior panel. At Apollo, we think of private credit in a much broader definition. We actually think it's a $40 trillion addressable market that spans everything from investment-grade fixed income through to asset-based finance, through to sub-investment grade opportunities. And so when you talk about education, I think our mission has been really to educate investors about how private credit can actually permeate throughout your entire portfolio and really have a place across, a portfolio. And that has been the education as well as the listening piece that we've been a part of.
Now, when you're talking to, I don't know, whether it's an insurance company, whether it's a sovereign wealth fund. I mean, when you're saying, you ought to have us as part, or you at least ought to have private credit as part of your allocation. I mean, what's the big draw for them? Is it yield? Is it diversification? Is it the idea that they don't want correlation to other assets in the portfolio? Or does it vary depending on who you're talking to?
I think it varies, but I think generally speaking, when you're talking about, there's a lot being said about private credit being a very large asset category. Is it a bubble, et cetera? I think when you think about private credit, on the other side, you're talking about public credit or public markets. And public markets are actually much more correlated, much more concentrated, and give less diversification for an investor when they're thinking about getting diverse sources of income, diverse sources of return, and diverse sources of ultimately correlation within their portfolio.
Well, one of the things that a lot of traditional investors, though, particularly like insurers that may be new to this, one of the things that we've heard is that a lot of them worry about the lack of transparency and also the idea that that there's a questionable secondary market for a lot of these, which makes them sort of like have to think harder about this. How do you respond to that when you're talking to people who want to consider it?
I think that, to your point, the lack of transparency that might exist in some pockets of private credit is not necessarily the standard. And I think it's about making sure that you're being transparent on price discovery, you're being transparent on sourcing, you're being transparent in terms of what these assets are being marked at on a frequent basis. And I think that as the private credit market continues to grow, as it becomes more and more established day by day, which we are seeing, you will see a market over time, right? You will see much more transparency, which will allow investors, I think, to gain additional comfort when it comes to investing in the asset class.
Well, this asset class is really sort of it's mushroomed. Now we're in a different environment now from a macro standpoint and from an economic standpoint. I mean, interest rates have really changed. And does that change the attractiveness of going at this, particularly, well, I'll come to the banks next, but first from an interest rate standpoint, does that make people sort of reconsider, or at least think differently about this?
I think generally speaking, you've seen a lot more interest in credit as an asset class, generally speaking, because of where interest rates are. Now, as mentioned previously, that doesn't mean that you can just layer on higher and higher coupons, for example, for companies to be able to bear. So what we try to focus on in private credit is still high quality, top of the capital structure, but you're getting paid, I think, significantly now, given where rates are, and you're getting compensated for additional risk in that regard.
Another thing that's happened recently that I'm wondering how it's affecting you is banks, which had gone through a period of trying to unload lots of things on their books, are now seem to be much more interested in lending again, and including to some of the types of businesses that would have sought private lending. Is that more competition now? Are you seeing that, and how do you combat that?
Yeah, I think that the banks have been great partners to the credit market and the private credit market. Obviously, it ebbs and flows in terms of their activity based on the markets, based on idiosyncratic events that they might be facing. But I think that their activity, their participation only continues to bolster the broader market. And so we view that not necessarily as competition, but as a partnership when we think about providing these types of financings, broadly speaking, to companies. And again, when we talk about private credit, we're not just talking about going to one company and giving them X billion-dollar loan. We're talking about doing that plus providing them an investment-grade financing, plus providing financing against their real estate portfolio, thinking critically about how they might do inventory finance. So having the full suite of options when it comes to providing credit, we think is going to be the better place to be so that you can pull from different diverse sources.
I mean, as we hear a lot of people, as we heard in the previous session, who are saying, there's been so many people who've run into private credit in recent years, but wait until we see a full cycle, or is there going to be some washout? Is there some fear there?
I mean, yes, I think that we haven't seen a full cycle yet as it relates to, new entrants to the market who haven't been cycle tested. So I think it just, again, underscores the need to be very critical in terms of the managers that you invest with, as well as making sure you're very clear in terms of where you're attaching in a capital structure and the type of risk that you're taking, in various market conditions.
Okay, I would love to continue, but the clock has ended for us. So I want to thank Akila Ghiriwal, who's Global Head of Credit Product at Apollo. Fascinating time.
Thank you so much.
That darn clock. I hope you guys are enjoying your conversations this afternoon. It's actually one of my favorite times of day. It's time for lunch. At this time, if you're registered to attend the special lunch session, Investing in Technology-Driven Business Transformation, proudly sponsored by Invesco QQQ, make your way over down to Breakout Space Hub 1, just down the hall, out these doors. And for the Bloomberg Financial Products Lunch, AI, machine learning, and its impact on the financial sector, you're leading to Hub 3, again, also outside these doors, down the hall. Our staff is right outside to help you. If you need any help, please do reach out. And for the rest of you, make your way downstairs. It's a very cool space down here at Caveen. That is where the general lunch will take place. Later this afternoon, we'll hear from John Zito of Apollo, SEC Chair Gary Gensler, Cliff Asmus of AQR, among others. Enjoy. See you back here, 1:45 sharp.